Today, all about household debt, a Property Imperative Weekly special. Hello again, it's Martin North from Digital Finance Analytics. Thanks for joining me again for another review of finance and property news. And this week, I'm going to do something a bit different. I'm going to look in detail at some of the latest data that's just come out relating to household debt. This is a very important subject, of course, because all of the media focus has been on the so-called property rebound, specifically in Sydney and Melbourne. And of course, this last week, the Australian Financial Review ran its conference specifically on the property sector, and Josh Frydenberg spoke there and once again underscored the need to have balance with regards to underwriting standards in code for there should be less barriers in the way of writing more loans. But the household debt issue won't go away, and the latest data really underscores that. So we're going to start by looking specifically at the data from the Reserve Bank. Now, the Reserve Bank publishes the statistical tables, and they've just updated them. And one of the things I look at when they release the information relates to the household and business finance information. And I'm very interested in particular in the E2 series, which looks at a series of selected ratios that tells us quite a lot about what's going on in household finances. Now, there's a few caveats here before we get into the detail. The first is that these are averages across all households, and quite often they also include small and medium enterprise business data in there as well. So the data is somewhat skewed, and they're averages, of course, across people who are borrowing and people who aren't borrowing. Nevertheless, the trends over time are quite interesting. So the first cab off the rank is to look at the RBA ratios relating to household interest related to income. And this is data to June 2019. And they show that the household debt to assets is sitting at 20.4 on average. And you can see that there's been very little variation over recent times. But the housing debt to housing assets has risen. It's now sitting at 29. What that shows us is that there is more debt relative to the value of the housing assets. Now, of course, that's not surprising because home prices have dropped on average, let's say 10 to 12% in the major centres. And as a result of that, the ratio of debt you would expect to go up. But 29 is quite a high number. And in fact, you have got to go back to October 2012 to reach anything close, in fact, slightly higher at just over 30. So this shows you that at the moment, with property prices sliding a little over the last year or so and debt rising, the pincer movement has worked against households. Now, the next series we can look at is household interest to income. Now, this is going to be quite an interesting series, of course, because on one hand, we know that rates have recently been cut and some people are therefore getting mortgages cheaper. But we also know that incomes in real terms have been flat for a long, long time. So we can look there at household interest payments to income. That's all types of loans, and that's sitting as 8.9. And you can see it's just turning down very slightly thanks to the recent rate cuts. The housing interest payments to income is also down a little, but is 7.4, and that's still quite extended, although not as bad as it was back in 2009 or 2008 when interest rates were a lot higher. Of course, we've seen interest rates come down dramatically. But you've also got to recognise that from 2015 to 2018, the Reserve Bank pretty much kept their rates on hold, and in that time, the ratios started to rise. And it's really only the interest reductions that have had an impact on the ratios. Then we can look at household assets to income. And here, total household assets to income now is at 938. And you can see there a little uptick. And that's because, of course, we've started to see in some places property values just begin to move up. But more importantly, the main reason for the movement up is the financial assets relating, for example, to stock movements, which have been quite positive in the time frame till June. Because Housing assets to income has slid. It's 483.5, and you can see that since February 2018, that ratio has actually dropped. And you can see that household financial assets to income at 428 has risen very sharply. And that is because financial assets, those in superannuation and those in stocks and shares, have risen as the markets have risen. So this chart shows you that there have been two sets of movements: a downward movement with regard to housing assets and a positive movement with regard to financial assets. Now, of course, not all households have other financial assets. So if you are the fortunate holder of stocks and shares, then you might be doing quite well. But if you only have a property, then you're doing less well. The next one is the household debt to income ratio, and this is the one that is trotted out quite often. And we've reached a new high. 191.1 is the household debt to income ratio, and that is the first time it's gone above 190. Now, this of course includes all households and small businesses and all types of debt. But the more significant one is housing debt to income, and that's 140.4 and continues to rise. Relative income households are piling on ever more debt. And the sharpest uptick of all is related to owner-occupied housing debt to income, which is sitting at 109.4, and the acceleration from 2015 is quite remarkable. And this is reflecting, of course, one, flat incomes, and two, relatively strong lending. Even now, lending growth is still positive. And this highlights the stresses and strains in the system as households are coping with high levels of debt. Now, there's another way of showing this information, and I'm going to compare now the mean home prices across Australia to the housing debt to income ratio. And that's quite interesting because what you will see there is that the mean home prices accelerated quite strongly up until 2017-18 and has fallen back. And the mean home price is just over $630,000 at the moment. But the housing debt to income ratio was following the home price movements quite strongly until 2018, but since then we've seen a significant reduction in the home prices relative to housing debt to income ratios. And this really demonstrates very strongly how much households now are more leveraged into property than ever before. And remember that this is up till June, so this is before the most recent initiatives from APRA and before the rate cuts came in, so we'd expect to see this ratio get even worse ahead. Now, of course, if home prices start to recover, then it may move the other way. But this highlights to me a significant pain point for many people. And there's another perspective just worth reflecting on, and that is the mean prices by state, according to the ABS, who publish their original data on a quarterly basis. It's somewhat delayed, but it does show some quite interesting trends. So we've seen the mean price in New South Wales go above $900,000 and slide now to just over $800,000. Victoria has seen prices again rise. In fact, they rose a little longer into 2018 before they've moved down again. Whereas in Queensland, the growth has been much more gentle. But again, we're seeing now a slide backwards and the mean price is dropping below the $500,000 level. In South Australia, the growth has been even slower. And again, we're seeing a slight correction now. Whereas in Western Australia, the peak of prices back in 2014, when the mean price reached around $600,000. But prices have continued to fall now, and they're sitting at on average $500,000. The Tasmanian home prices, which were sitting at around $300,000 in mean terms, right the way through 2012, 13 and into 2014, have risen slightly, and they're now a little over $400,000. And of course, Tasmania is the market that is bucking the rest of the markets, insofar as there is still quite a lot of demand, and prices are relatively firm. However, volumes are significantly down. Northern Territory prices, on the other hand, have been drifting lower since the 2013-2014 timeframe, and the average price there is still above Tasmania at a little over $400,000. And then finally the ACT, where prices have been rising quite consistently, if slowly, since 2013 and 2014. Now, they're supported, of course, by average incomes which are higher in the ACT, thanks to the public sector. Now, of course, the mean prices are just averages, and there will be some above and some below. Now, the other source of data I want to talk about today is the Bank for International Spain. Now, the other source of data I want to talk about today is the BIS data. Now, the other source of information I want to talk about today is from the BIS, the bankers. And they publish quite interesting data, specifically relating to credit to the non-finance sector. And the one that is of particular interest to me is the credit to households. And we look here at the relative ratios compared to GDP, for example. And that gives us some quite interesting comparisons across different markets. The BIS data is quite useful insofar that they've tried to normalise for differences across different locations, and to an extent, this is probably the best comparative data around. It's not perfect, but it does tell quite a powerful story. So, the first thing we're going to look at is the household debt servicing ratios to March 2019 across a number of countries. And so this is the most recent data that's available from the BIS. And Australia holds the prize at 15.6 times, which is remarkably high. The Netherlands are behind us at 15.3, Norway at 15.1, Denmark at 15, Canada at 13.3, Korea at 11.8, Sweden at 11.5, the United Kingdom at 9.3, the United States at 8, Belgium at 7.6, Finland at 7.2, Japan at 6.8, Spain at 6.5, Portugal at 6.5, France at 6.3, Germany at 6, and Italy at 4.3. So this tells us that relative to many other advanced Western countries, households are simply spending way more servicing their debts relative to other countries. That's one reason why households are feeling the pressure at the moment and why mortgage stress is so high. Now, as well as looking at the most recent data on debt servicing ratios, we can also look at the trends over time. Here is the Australian trend, and you can see there that the ratio has been sitting above 15% for quite a long time. In fact, it had reached a high before the GFC of about 17, came back a little, and has been roughly parallel since 2012 at sitting around 15 and above. Now, the Netherlands in comparison was significantly higher, but is now dropped below us, whereas Norway was tracking quite close and is again slightly below us now. Denmark was extremely high back in 2008 and 9 and has now squeezed below us again, whereas Canada is consistently lower and is sitting at around 12.5 times. Korea is lower, Sweden is lower as well, and the United Kingdom is consistently lower and well below 10. But the United States is lower still at about 7, and Belgium is lower still, if rising slowly, as is Japan, Spain, Portugal, France, Germany, and Italy. So you can see from a trend perspective, household debt service ratios based on the BIS data shows that Australia is right at the top of the pack and has been consistently rising in recent times. And that again signals significant issues with regard to households here relative to other countries. Now, another way to look at this is the credit to GDP ratio. And here you can see that Australia is close to 200 and has been climbing right the way back from the year 2000, with a few wobbles up and down around the GFC. New Zealand tracked Australia quite closely and in fact in 2009 overtook Australia, but is now tracking a little below, so below the 200. The United Kingdom is tracking a little lower, as is the United States, that is sitting around the 150 mark. Canada is sitting above us in terms of credit to GDP. Finland in the middle somewhere. The Netherlands is significantly above us. Germany also above us. Spain below us. Hong Kong significantly above us and still climbing. Whereas Ireland has had a really bumpy ride, was very, very high, up to 400 back in 2015 and has dropped away. Sweden, again above us. Germany, well below us, so just over 100%. And Switzerland is also above us. So looking at total credit to GDP doesn't look too bad. However, that includes businesses and other elements, not just households. So in a way, this is a rather misleading picture. But we can also look at household debt to GDP, which is a more focused set of data relating specifically to what's going on in households across different countries. And on that basis, well, Switzerland holds the prize at 129.5. Australia is a close second at 119.4. Then Denmark at 115.1, followed by the Netherlands, Canada, Norway. New Zealand is at 94.4. So relatively speaking, the household debt to GDP ratio is significantly worse in Australia relative to New Zealand. Then Korea, Sweden, the United Kingdom at 87, United States at 75, the Hong Kong SAR at 73, Thailand, Malaysia, Luxembourg, Finland, Portugal, Belgium, France. The G20 aggregate is at 58, which is well over where we are. Spain, Japan, the Euro area, Germany, China, Singapore, Greece, Austria, Chile, Iceland, Israel, Italy. Emerging markets down to 37, Poland 35, South Africa 34, Czech Republic 32, Brazil 28, Colombia 27, Hungary 18, Russia 18, Indonesia 17, Mexico 16, Turkey 14, India 12, Saudi Arabia 11, and Argentina 6. So you can see there's a massive spread, but you can also see that Australia and indeed New Zealand are bunched up near the top, and Australia holds the silver medal for household debt to GDP based on the BIS figures to March 2019. Now we can also look at household debt to GDP trends, again based on the March data, and Hong Kong SAR is sitting at around 78. The Netherlands was higher at 120 but is falling back close to 100 now. Denmark is sliding and is just under 120. Norway is below that. But New Zealand is on the rise and is getting towards the 100 mark. China is at 53.6. I think that's quite interesting watching that rise. And of course, we would expect that to continue to grow as the economy continues to mature in China and as more members of the middle class take more loans. The United States ratio is falling, and that's below 80. Switzerland is consistently higher, and that's partly explained by the international footprint of finance in Switzerland, I think. Canada is consistently lower, but Australia is 119.4 and is in second place behind Switzerland. Sweden, significantly lower. The United Kingdom, significantly lower. And Ireland, which was very, very peaky back in 2009, is now sitting at 41.7. So on this trend chart, we can see just how troublesome debt is in Australia and to an extent in New Zealand, but Australia is streets ahead. So let me just conclude with a couple of thoughts. The first is I've tried to demonstrate that household debt in Australia is extremely high on any of the critical measures we look at. And we need to offset this against all of the initiatives that are in play at the moment to try and encourage people to borrow more. And we discussed the reasons why this is the case and why there is so much pressure on households to try and borrow more in our recent post. And you can watch that to understand why it is that the government, the property sector, and the banks are all spruiking property higher. But I keep saying, and I will say again, households are stretched, very stretched. And despite the fact that lending standards may be loosening a little, household debt is still rising relative to income, relative to all the other ratios that we've looked at, and we are an absolute outlier on an international basis. And I don't think that's a good thing. But the takeaway from today is that household debt is a big deal, and we need to be very cautious about just grabbing ever more debt, even with interest rates a little lower, because there is a thought to leave you with. As well as servicing debt, you have to be able to repay the debt. And in a low inflation environment, with incomes flat and the debt not being eroded by inflation, later, however much later it's going to be, people will still have to find ways to be able to repay the capital. And that is the concern that I have. This could all come undone, and it could come undone quite quickly because we are, frankly, debted out. Now, before I finish this special presentation, I will just recap on the CoreLogic Index to the 26th of September 2019. In Sydney, prices rose in the last week 0.27%. In the last quarter, they've risen 3.3%. Annually, they've fallen 5.2%. And from peak, they're down 12.2%. In Melbourne, they rose last week 0.31%. Over the quarter, they rose 3.27%. They've fallen 4.2% over the last year and are down 8.1% from peak. In Brisbane, they rose 0.08% over the last week. They've risen 0.58% over the last quarter. They've fallen 1.8% over the last year, and they've fallen 2% from peak. In Adelaide, they're down 0.12% over the last week. They've fallen 0.68% over the quarter. They've fallen 1.3% over the last year, and they're down 1.7% from peak. In Perth, they're down 0.45% over the last week, down 1.98% over the quarter. They've fallen 9.2% over the last year, and down a massive 21.4% from peak. And across the major five, prices rose 0.15% over the last week. They've risen 2.16% over the last quarter. They fell 0.4% over the last year, and they've fallen 9.9% from peak. And as I always say, these are averages, of course. Individual properties and individual locations will vary. And finally, the other way we can look at this information is to look at the annual movements over the last year, again, based on the CoreLogic series. And we can see there that Sydney, having fallen quite consistently until May, started to climb in July and continues to rise. Melbourne follows a similar pattern. Brisbane is moving very slightly higher, but hardly noticeably really, whereas Adelaide is definitely falling at the moment, and Perth continues to dive further south. And the five cities average, because of course it is weighted towards Sydney and Melbourne, is also higher. But again, to re-emphasise, these movements do vary, and these are averages across the various locations based on the CoreLogic series. The other thing to say before I close is that with regard to the home price movements, we can see that there is some recovery in some places if those indices are anything like right. But remember that the volumes remain very low. The auction clearance rates may be high, but again, transaction volumes are low. And we're also seeing very low levels of new properties coming on to list. So we need to be very careful about this data and what's happening to home prices, because we could well be deceived into thinking that things are more positive than they really are because of the low volumes of transactions. The settlements are still significantly low, as CoreLogic showed recently in a report that they did. Settlements are significantly down relative to a year ago, and that's true in pretty much all the centres, but some more than others. Indeed, CoreLogic showed that the monthly sales with the 6-month moving average are down nationally 16.9%, among the combined regionals down 16.4%, but amongst the combined capitals down 17.4%. And among those regional areas, regional Queensland is down more than 18%, as is regional Victoria. And if you look across the major cities, Melbourne is the standout, with sales down 25.8%, then Brisbane at 18.6% down, and Sydney 17.6% down. In fact, Darwin is the only centre where sales are a little higher, up 1.6%, but of course they took a bath earlier on. So that's another reason why it's really important to set the price information in context. Very low volumes means that prices may well be distorted, and I think we're going to see more of that ahead. And let me just say before I go that if you want more information relating to the recent repo operations in the US, I've done a post on that. And I've also done a number of posts over the last week relating to some of the other issues in the marketplace more broadly. So I wanted today to focus on something different, the household debt. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.